Welcome to the Money and Wealth Show, brought to you this week by American Manganese Incorporated. Here's your host, Sterling Fox.
Welcome to the Money and Wealth Show, where each week we bring you guests with opinions. And this week's guest is the Chief Investment Strategist with Institutional Advisors. It's a real pleasure to welcome Bob Hoye to the program. Hi, Bob.
Sterling, good to be with you.
It's great to have you with us, sir. Your impressions of 2010, the year that was.
Well, it was a very exciting market through the first part. We had a huge rally up to April, which was what we were looking for. That was the stock market plus some commodities. Then we were looking for a good correction off of that, which we got. Then a recovery into the fall. And this was sort of an intermediate nature. So then as the fall progressed, we got into November, and the market started to get pretty excited. You had demand for the grains because of a growing year of unusual weather. Then we got into unusual cold weather in England and in Europe. That drove the heating oil up. And then the crude oil went up, so it became a party. And this is one of the things that researchers and also policymakers are interested in, is when you have a methodically rising market, which is good, then all of a sudden you get into where it goes straight up, which is great while you're long, but it's ultimately bad because strong speculative markets will eventually fail.
Back in 1998, you and your colleagues developed something called the Momentum Peak Forecaster. What is that, and why did that particular alarm bell go off towards the end of 2010?
Well, it relates to momentum, but it usually gives a 2-month lead, and it doesn't kick in until the markets are making a very powerful rising move. And where we've back-checked it all the way back to example in 1973, which was a very hot commodities market, and it gave the signal. It goes straight up when the action in the speculative items is going straight up. Then, when it stops going up, that then means within a month or two, the play will fail. And it has worked then in general commodities. It worked in January 1980 when gold and silver went to the moon. And then it worked in 1987 before that stock market crash. Then in, as we say, 98, when it came in then, that was in anticipation of the disaster with long-term capital management, that huge $5 billion hedge fund that crashed big time. Then the next big one was in 2006, when it gave the signal, and what that related to then was the peak in the U.S. housing market. Their Schiller index on house prices peaked in that June, July, and this gave the signal in May.
This was the beginning of the downward spiral in U.S. home prices that continues to this day, doesn't it?
Yes. There was some relief rally late in the year but in house prices, but it looks like it's running out of energy. So that was a critical. Now here, this thing started to pick up in November. So you start seeing the graph going up. We took a look at it. And then you look around and say, what's the speculation in? Well, the speculation is in everything. It's what we call the all-one market. So you get a downtick in the U.S. dollar, and you'll have base metals up, you'll have the grains up, you'll have corporate bond prices up, and you'll have the stock market up. Then you go into a week or so where the U.S. dollar index goes down a bit, or goes up a bit, then all those things go down. So it's effectively all one market. So this isn't selecting one speculation. It's looking at the speculation in all the hot games.
Well, I wanted to read this because I've got a quote of you just a couple of weeks ago on January 1st, your predictions for 2011. And the quote goes something to the effect of intense speculation followed by a severe setback. This is because of that momentum peak alarm that went off in early December.
Yeah, that was our alert to it, and that was when it got up to 1.25. When it gets above 1.21, it means there's an alert, danger. So I started writing about it then. And then at the end of December, just a couple of weeks ago, it did get up to 1.28. For example, in 1987, before that crash, it got up to 1.87. or 1.37. So at any rate, it's up pretty high. And now we start counting. 1 week, 2 weeks, 3 weeks, we don't know, 4 or 5, maybe 6, 8 weeks. Then the liquidity problem will come in. And one might ask, why would there be another liquidity problem when the Federal Reserve and the U.S. Treasury has been providing so much stimulus?
Right.
Well, what it is the interventionist economics have a theory that if you provide the liquidity, it'll fix the bad things. But the thing is, the liquidity goes into the banking system, which is essentially Wall Street. Wall Street is not going to put money into losers. They will put money into what will become winners. And going back to the crash that ended in March of 2009, the winners have become base metal prices, the grains, corporate bonds, and the stock market.
So this is the big complaint with all of this stimulus, hundreds and hundreds of billions of dollars. It hasn't gone, it's gone to Wall Street, and Wall Street has made the decisions as who the winners and losers will be. So in addition to private citizens receiving not a thin dime of any of this money, Wall Street has made decisions behind closed doors about who wins and who loses, again beyond anyone's control.
Yes, it's not quite as cynical as that. They don't choose what is going to be the winner. They avoid the losers.
Okay.
They're not going to go bail out a failing municipality or a failing country. It'll go where they can make some money, and then it becomes a party. So, and this is here is the failure. I think when this speculation finishes, I believe it also marks a severe failure mark for all of the theories of economic intervention, which is always to throw more credit at a credit problem. I don't think it's going to hook up.
Our guest this week on the Money and Wealth Show is the Chief Investment Strategist for Institutional Advisors. And we'll have lots more with Bob Hoye after this.
Always consult your investment professional before making any investment decision.
American Manganese Inc. has a world-class deposit in Arizona, indicated 6.7 billion pounds, inferred 8.9 billion pounds, potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at TalkDigitalNetwork.com. Here's Sterling.
Welcome back to the Money and Wealth Show. Ours is an on-location program, and once again this week we are on location at Churchill's in the Holiday Inn in North Vancouver with our special guest, the Chief Investment Strategist with Institutional Advisors, Bob Hoye. Now, Bob, you painted a rather dire picture so early into the year only of 2011 because of this momentum peak forecaster system that you've devised over the past 20 or so years. And all of the elements came together a few weeks ago and caused the alarms to go off. And you said all in one markets. Basically, everything is under alarm this time. People watch on everything. And then you went on to forecast some pretty intense times ahead. What sectors are likely to take or the most turbulence? Let's put it that way.
Yeah. The side that's been the hottest. So you've had outstanding move in silver. Fabulous move. Great move in the silver stocks. Silver Wheaton is the big one. Growth stock there has done very well. And about 3 weeks ago, it gave, this is a separate signal, what we call an upside exhaustion, meaning the people who really wanted to buy the stock have bought it. Mm-hmm. And it's been in a moderate decline since. So and then also the base metals themselves, including the base metal stocks, have been outstanding, absolutely. And copper is still firm. But it is now getting into a technical mode where one would watch for the end of the move. So we have a few indicators that are measuring excess. One of the other ones that is always reliable is in the stock market, where you have sentiment figures. How many bulls are there out there and how many bears? Mm-hmm. And the bulls have been very strong and very loud and measurable. One is the TRIN indicator, and it's a sort of a mix of upside volume and downside volume on the stock market, and it has given the strongest reading since the 1960s. So that they're altogether, market sentiment is extremely positive.
So you're saying strongest reading since the 60s, what, on upside and downside? People on the sidelines who are playing in the game, there's so much activity. It hasn't been like this since the 60s?
Yeah, on this one indicator, the
Interesting.
TRIN.
Okay.
So once the extreme bullishness is in, the old saying is that the market never accommodates the desires of the crowd. And according to the sentiment figures, the crowd is in the market. So then there's bound to be disappointment, because who's left to bid stocks up further? Not very many people. They're all in the market. Then the other dynamic is the one we've been talking about, our momentum peak forecaster. And that doesn't come in very often since 1970, backtracking it to 1970. There's only been 5 really good signals on it. And it's a very important warning. So you have sentiment and you have momentum. And that is what you need to have the conclusion of a really outstanding speculation, which this has been. And it's interesting, Sterling, also, the all-one market where everything is bid up, it's against the US dollar being bid down. And it is interesting that the low for the US dollar index was in early November, on the day that Bernanke announced the quantitative easing part 2.
Right.
And that was where the Fed effectively said, we're going to trash the dollar. But, like all big news stories, it was in the market. So then the US dollar index has been recovering since then. That was a low of 75.5, and it's now up into getting almost 80. So what you have here is that with the stock market crash that started in 2008, actually the stock market high was in 07, but you then had an exceptional low on the US dollar index of 70.7. And then you had market sentiment at that time very bearish, because there was only 7% of advisory services that were bullish, so 7% bulls. Then the next low at the end of 09 was at 74 and change, and then that one was marked in as only 7% of advisory services were bullish
Again.
on the dollar.
Okay.
Now the latest one in November, because you had all of the Bernanke stuff about that the U.S. Federal Reserve was going to trash the currency, it was in the market, but the percent bulls got down to only 3%. So you had a higher high going back to 2008 at 70, 74.5, and then 75, 76 next low, with more bears. So the U.S. dollar is in an uptrend.
Oh, really? Because, of course, since New Year's, the Canadian dollar has been a whisker above par with the U.S. And while a lot of Canadians appreciate the opportunity to go to Florida or Hawaii, basically for even money, Canadian manufacturers are taking it on the chin, Bob. How likely is the Canadian dollar to remain at this height, equal to or slightly above the U.S. dollar?
Yeah. First of all, Sterling, I really like the U.S. dollar at par. Again, we're all consumers in this country, and it makes the prices of other goods coming in more competitive. And Canadian businesses really don't have to have a cheaper U.S. dollar or Canadian dollar in order to thrive. They can learn how to get by on a sound currency. But it's still called the commodity currency. Commodities have been very hot, and they will roll over in, on our peak momentum forecaster. And so then the Canadian dollar would weaken relative to the U.S., but mainly the U.S. dollar has been rising. That's the dollar index, whereby the euro, I think, is a 57% weighting. So the Canadian's been doing well. The other currencies were not doing well.
So are we likely to remain pretty close until, say, summertime?
I think that with a correction, the first correction, maybe the Canadian dollar can get down to about 94, 95 relative to the US. That's not a big drop these days in foreign exchange markets.
Our guest is the Chief Investment Strategist with Institutional Advisors. A real pleasure to have Bob Hoye with us this week on the Money and Wealth Show. Lots still ahead. Stay with us.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's Sterling.
Welcome back to the Money and Wealth Show. Our special guest this week is the Chief Investment Strategist with Institutional Advisors. Bob Hoye is also a student of history. And Bob, I'd like to call upon your historical background to respond to a true or false. No government has ever been able to print its way out of a crisis. True or false?
It's never happened. It makes the problem worse. The whole thing is, once the public gets into a speculative mode, and then you get to the hyper speculation, which, well, that's excessive term, but into strong speculation, then you end up with a crisis, because once prices stop going up, the latest rush of buyers have been on margin, where they're leveraged up, and if it doesn't go up, it's not a successful strategy. They've got to start selling. Then along comes Mr. Margin and hits them. And let's face it, Mr. Margin has an entirely different job description than your basic central banker.
True.
These days, central bankers are so reckless that one could say they've been trying to get the accounts out of line and highly leveraged, whereas the margin clerk's job is to get the accounts in line. And every time there's a speculative break, the power shifts from the central bank to the margin clerks. It's as simple as that.
Has it been tried, though, in the past? We see Bernanke and the Obama administration frantically printing money as fast as those presses will allow them.
Yep.
Actually, they're just moving zeros on keyboards on computer screens. But, you know, the printing of money is pretty easy to relate to.
Yeah.
Have other governments elsewhere on the planet tried it in the past with spectacular lack of success?
Precisely. In the South Sea bubble, and was also the Mississippi bubble in France in 1720. And John Law was the first really reckless modern central banker with his Banque Royale in Paris. And he had 8 printing presses going. And he had substituted his banknotes from his bank in lieu of coinage. And everybody was in love with it for a while. Then the markets blew up, and when they started to fail, 8 printing presses in Paris couldn't keep the party going. Eventually, the public wanted to see the plates for printing the banknotes destroyed because they'd had enough with inflation and it crashes. The first intellectual to come up with the idea of throwing credit at a credit contraction was a guy by the name of Edward Misselden. In the crash, there was a horrendous crash from 1618 to 1623. Then it was followed by a long period of bad times. But he suddenly saw the contraction, saw the unemployment, and then looked and said, oh, all you have to do is have a fund of credit, and it'll float credit into the thing, and everything will be fine.
Well, we know that was wrong. So in 30 seconds or less, why on earth are they proceeding with this insanity?
Because they haven't read any history. The policymakers have read theories. And the main theory is resting upon John Maynard Keynes. And when he was a young man and proposed all these ideas, he had not read any market history or any economic history. He had read philosophy. So he dreamt it all up that a state could come in and throw credit adequate credit contraction, and everything would get well. So it's amazing. I think that prior to the 1929, he was a fairly lucid writer. Then he didn't get out in 29. He took a bath, and then he found solace in his concept of the liquidity preference. So Keynes was a great talker, and the only reason why interventionist economics has been so employed for all these decades is because it empowers the state.
Right.
It puts lots of power and puts lots of money into the hands of the state. And then with Bernanke and Obama in the States, Bernanke's trying to prove a theory that's unprovable, and Obama wants to expand the state. So all of the stimulus was essentially to expand the authority, the power, and the money that's going into government coffers.
You talked about a great year that silver had in 2010. We've only got a couple of seconds left, but we can't not discuss gold, however briefly.
Yeah.
With respect specifically to people taking a look at this printing of money business and going, I don't think so. Is there a lot of that in why gold has gone so high?
Yeah, but also in every post-bubble contraction, the real price of gold goes up relative to everything, and that means the cost of mining is level and the price of bullion is good. So every post-bubble period has had a long bull market in gold. And the juniors have also done very well in this kind of environment. So we're looking for, perhaps after January, a correction in most of the big markets, including the precious metals. But out of this correction, you would have then the resumption of a pretty good bull market for the gold stocks, where they will make great gains, and it would be probably the start of another decline for New York Stock Exchange. You know, ordinary type stocks will probably net out with serious losses over the next couple of years.
Our special guest is Bob Hoye, Chief Investment Strategist with Institutional Advisors, and Bob will have a final thought for us after this.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Gold Ray Resources Corp is developing a gold mine in China. Identified resource, 175,000 ounces of gold down dip to the south of an existing 1,500 ton per day operating mill. Resource remains open down dip into the east and west. Trading symbol GOR on the Venture Exchange. Website goldray.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's Sterling.
And we're back with a final thought from Bob Hoye.
By summary, we've got the indicator gave its highest signal at the end of the year, which means that the speculation could continue, it could get hotter, but it also, the hotter it gets, the harder the fall. But the main thing from this indicator is that between 1 and 2 months hence, the markets, the speculative side, will fail.
Our thanks to Bob Hoye and also to Fritz and the crew here at Churchill's at the Holiday Inn in North Vancouver for the hospitality. I'm Sterling Fox, back again next week with another edition of The Money and Wealth Show.
The Money and Wealth Show, brought to you this week by American Manganese Incorporated.